Hello and welcome back to the Global LPG Conversations podcast. My name is Peter Wilton. I'm editor of the Argus International LPG Report, our daily pricing service. And today we are completing our three-part series looking at the initial impact on markets and prices of the burgeoning global trade war, specifically on the tit-for-tat tariffs levied between two key players in the LPG market, US and China. So in the first of our series, we detailed how the tariff escalation played out, and we dove a bit into the volatility that it caused on Asian and European prices. In the second, we did a sort of a deep dive on the Chinese market specifically, looking at potential for demand destruction there. And now we round off the picture, quite rightly looking at the key global supplier of LPG, the US. And to this end, I'm joined by Amy Strahan, our US editor. Hello, Amy.
Yes, good afternoon.
Hi. We've discussed on previous episodes in this series, and please, listeners, do check these out. We've been discussing how Asia and European delivered prices have adjusted sharply downwards, and very sharply downwards in the wake of the tariff announcements. But Amy, how has the US market fared? What sort of price movements have we been seeing there?
Sure. Well, the U.S. is, of course, extremely receptive to movements in delivered prices, especially AFEI, since Asian countries, of course, are the largest buyers. So when AFEI fell below $500 a ton earlier this month, we saw April prices at Mont Belvieu, Texas, follow suit. So April propane at Mont Belvieu fell by nearly 25 cents per gallon, or that's about $129 per ton for people elsewhere in the world, just between April 2nd and April 9th, hitting 67 and 3/4 cents per gallon, which is about $353 per ton, which was a nearly 6-month low before it began to recover with the subsequent gains in AFEI. So this was basically a half-hearted bid to sort of prop open the arbitrage to Asia. Uh, as you touched on in the earlier conversations, the U.S. market, of course, needs China to absorb the huge production gains we've seen here in the U.S. in the past 5 years. Looking at Kepler data, China accounted for about 17 million tons, or 33% of U.S. propane exports last year. The world is the largest supplier of LPG and, of course, is dependent on exports to maintain not only our domestic LPG balances, but to also keep the crude and natural gas flowing. U.S. LPG is still very much a byproduct of oil and gas production here, and we need exports to make it all run smoothly.
Okay, so you mentioned there's quite a portion, sorry, of US exports that China takes, but we've now got 125% tariff on all US goods, including LPG. So that's going to effectively stop the flows. It's almost as good as an embargo on them, really, that with the tariff level being so high. So
Yeah.
where will these exports be redirected? Is that possible? Will they be?
They will have to be redirected. It's kind of anyone's guess at this point how this fundamental shift in trade flows are going to adjust. Flows from the U.S. to other buyers like Japan and Korea are likely going to increase. Already last week, we observed a huge surge in cargoes out of the U.S. in April that were directing toward Japan, actually roughly twice what Japan can take in the wintertime. But obviously, Japan's not possibly going to absorb all of this additional volume. So we'd expect a lot of this to be distributed between Korea, India, and Indonesia, and possibly a portion of it, of course, re-exported to China via Japan or Korea. Really, sort of any way you look at it, it creates huge inefficiencies in the trade flow. And this, of course, is creating opportunities for traders, but it's a major headache for end users, assuming that we don't simply see demand destruction in China as a consequence of the trade war.
Right. Okay. And what has it done to the spot cargo premiums out of the US? I mean, just for the uninitiated, this means the premium paid over and above the US domestic prices to get your LPG loaded onto a vessel there for export. So what's it done to these premiums?
Right. We're talking about terminal fees. And,
Hmm.
early on in the trade war, the ARB actually initially narrowed to the point where you couldn't ship the propane at the cost of spot freight on a Houston to Chiba basis. And so that, of course, led to fears of widespread cancellations in the U.S. market, which we haven't really seen in more than a year. So your spot terminal fee discussions dropped as low as Mont Belvieu plus 4 cents, which is basically at cancellation at level economics. but they quickly rebounded as freight fell, and the FEI, of course, recovered. So discussions for May loading full propane cargoes are now just below Mont Belvieu plus 6 cents, which is about where they were at the end of 2023, um, before all that tightness in U.S. export capacity pushed premiums into the double-digit numbers that we've actually seen for most of the late 2024 and then earlier into this year.
Okay, sure. And guess the biggest question, really sort of zooming out a bit, is what this all does to global demand. So earlier in the series, we had Francis Go, our editor in Asia. Now that sector has been a major driver of US trade flows, a major sort of recipient of US gas. So will the US scale back its own production as demand from that sector wanes? I mean, can the market even scale back in the US? Is that possible?
It's very difficult. Unlike the Middle East, the U.S. doesn't have a central authority that dictates production. U.S. producers, if they decide to curtail production at all, are much slower to react since they're making these decisions largely based on crude and natural gas prices, not LPG. During COVID, for example, we saw U.S. propane production from gas processing actually increase from about 1.7 million barrels per day in 2020 to 1.87 million barrels per day in 2022. And now, of course, we're closer to 2.1 million barrels per day. And this is all on the back of gains in natural gas drilling and natural gas production. But the production gain we've seen in the last 5 years was happening at a time when demand from China and other countries was also rising. As those governments in emerging markets, like India, during COVID, heavily subsidized LPG to support retail consumers. At that time, China, of course, as you mentioned, was ramping up its PDH capacity since plastics were in very high demand. But this time, this threatened slowdown in demand for U.S. LPG is really more pronounced as it takes China out of the equation completely. That leaves about 500,000 barrels per day of U.S. propane exports theoretically without a home. The U.S., of course, is very sensitive, as we mentioned earlier, to declines in pricing in Japan and Korea. But even then, we have the bigger barrel picture to worry about. U.S. Natural gas LNG exports are also threatened by the tariffs. And so with them, there's a major driver for U.S. natural gas drilling, which again has been sustaining most of our LPG production. And at the same time, we've seen crude prices fall. So all of these factors, if they persist, we're going to weigh on U.S. drilling programs.
So sort of, yeah, taking all that into account, do you think the US production will lower?
Um, Probably if we continue on this path, especially for a lot of the independent drillers. In one case, Apache is a Permian oil and gas producer, announced this month that has modestly scaled back its production this quarter, and that resulted in a 500 barrel per day decline in NGL output. That's only one independent producer and a comparatively small bit of lost production, but it's a really ominous sign. There was an April survey from the U.S. Federal Reserve Bank of Dallas, and they asked producers in the Permian Basin sort of what prices they need WTI to be. And they said they needed between $33 and $35 a barrel to keep the existing operating wells running. But when they asked them about, well, what break-even costs for new wells in the Permian Basin would be, and they said they need WTI between $61 and $62 a barrel. So the outlook for increased production is really kind of precarious at the moment. And what's really worrisome, and I suppose we'll get more clarity from the midstream operators very shortly in their first quarter earnings calls, is whether this is going to have a chilling effect on the new infrastructure projects that have already been announced. Most of these investments are sunk costs, like additions to the refrigeration capacity we've seen announced at terminals in Houston and Nederland. Enterprise's Neches River Complex, which was going to be used to shift much of its ethane export capacity eastward, away from Morgan's Point, Texas. is already well underway. So we have the risk now of underutilized new terminal export capacity here in the U.S. that will sort of likely put a ceiling on spot terminaling fees for cargoes that aren't moving out under term contracts. But particularly for projects that haven't actually broken ground yet, like ONEOK's planned new LPG terminal that was slated to start up in 2028, could possibly face delays because of this.
Okay, yeah, so very, very possible we do see some pretty serious impact from all this. I mean, as to be expected. Now we've been talking about LPG sort of exclusively here, but of course ethane has also been hit by these tariffs from China. The US is the world's only real major exporter of that product, and now it's been brought into the sphere of these tariffs. What's the situation looking like for US ethane
Yeah.
exports going forward?
Right, right. Well, China's been sort of a major driver of ethane export expansions here in the U.S., but what it's a 125% tariff, the economics on shipping ethane to China for cracking simply don't work. So by the end of next year, we've got about 400,000 barrels per day of excess ethane loading capacity when you look at the new projects and the existing contracts with Chinese buyers, and we've got nowhere to move it.
So we should then expect declines in ethane prices as well as the propane prices in the US on that basis.
Yes, yes.
Yeah.
I mean, we have U.S. storage available.
Okay.
It can be expanded. We've got these salt caverns, of course, beneath Mont Belvieu. But particularly in the case of ethane, it's likely we would start to see more rejection of ethane volumes into the natural gas stream. But higher rates of ethane rejection out of the Permian Basin, which we haven't really seen in a couple of years now, simply means we have more volumes of gas coming on at a time when the outlook for LNG cargoes is also pretty precarious. So yeah, it's also interesting to note, going back to sort of the structure of the forward curves for ethane and propane, these tariffs pushed Mont Belvieu propane into a 12-cent per gallon, which is about $62 per ton backwardation heading into the summer, which means operators are going to push out as much as they can right now because it's simply not profitable to store it. And this is particularly worrisome for domestic end users in the United States because U.S. propane stocks were about 9% below the 5-year average in early April, and this really sort of disincentivizes people to store.
Yeah, absolutely. I mean, talking of just looking globally, it's a story Argus have been telling for a long time that LPG is just sort of structurally long globally, but not quite to the extent that it is now. I mean, these things are just going to push it further deeper into that sort of length that we've come to expect, but maybe to a sort of not unmanageable, but to a much larger extent than anybody could have ever forecast before. Is that how you see it? The global market
Right.
lengthening quite extensively?
For right now, and of course, unless something changes, it certainly looks that way. Regardless of how the trade flows out of the U.S., it looks like PDH utilization in China will probably decline as a result of this. And without significant cuts to gas drilling here, U.S. supplies of ethane and propane are only going to increase. And so, in turn, this is all going to wash out and probably contribute to even lower LPG prices in both Asia and Europe.
Yeah, no, absolutely. I think that's sort of the only conclusion we can draw at the moment, whilst these tariffs remain in place, at least to the extent that they are now. So yeah, thank you very much, Amy. I think that really sums it up nicely, and it's great to complete the picture, bringing the US into this series. It just remains for me to, I guess, thank all those for tuning in to the latest installment. But to remind the audience, please do check out the first 2 parts of this 3-part series into the initial fallout of the tariff escalation. And of course, we will be back with more content in due course as the situation evolves, which we expect it to. It's been a very rapidly moving picture so far, and we don't see that slowing down. So we'll be back to give our views as and when there is any change to the status quo. Thank you very much for tuning in.